In this video, let's compare three very popular covered call ETFs. They are JEPY, SPYI and GPIX. All three are based on the S&P 500 with derivative overlay for yield and income. Covered call funds can be a valuable tool in retirement, but not all covered call funds are created equal. My goal for this video is to make the pros and cons for each as clear as possible. The S&P 500 is a blend index, and it doesn't show a high growth profile like, let's say, Nasdaq 100. So the yield and upside from JEPY, SPYI and GPIX will likely be lower. On the flip side, Nasdaq 100 is a much riskier index. So going with the S&P 500 can be a more prudent step. In my previous video, link here, I looked at JEPQ, GPIQ and QQI, which are based on Nasdaq 100. Next, let's briefly go over covered call strategy. Covered calls is what provides that valuable income that many investors go after in these funds. If we look at the S&P 500 yield, it stands at about 1.1%. In comparison, the distribution yield from these funds range from 8% to about 12%. So most of the income comes from selling call options on the S&P 500. Selling a call option provides that premium income, but it also caps the upside. So when the S&P 500 rallies, all three funds will lag behind it by their design. But at the same time, if the index falls, these three funds may fall by a little less. For instance, if we compare our three funds, SPYI fell the least when the S&P 500 dropped. That's what downside capture ratio tells us. Lower reading is best, keeping other things constant. But either way, covered call ETFs do fall, and they don't provide material downside protection. At the end of the day, they are equity funds. At the same time, all three funds capped the upside with the covered calls. Of the three, GPIX captured the most upside. Higher reading for upside capture ratio is better, keeping other things constant. That way, when the S&P 500 recovers, the fund is not left behind. It looks like JEPY caps its upside most of the three funds. As we'll see shortly, that's not good, given how the stock market tends to trend up. One rule of thumb for covered call funds is that their upside capture is lower than their downside capture. In other words, the lag compared to the S&P 500 is amplified in up and down markets. The best outcome for covered call funds is sideways markets. In that case, they get to keep their premium income and not get their upside capped. So in sideways markets, it's quite conceivable that covered call funds will actually beat their underlying benchmark. Let's look at the summary table. All three funds distribute income monthly. We see that SPYI by NEOS is the most expensive one. At the same time, it offers the highest yield at close to 12%. As expected, all three ETFs lean on the tech sector, as the S&P 500 does at this time. Let's look at JEPY. JEPY does not hold the S&P 500 stocks one for one. In fact, JP Morgan emphasizes that JEPY picks a more defensive portfolio of stocks compared to the S&P 500. The fund uses proprietary models to select equities from the index. The main goal is to generate a better risk-reward profile and smaller downside. JEPY top 10 concentrations and sector allocations are different from the S&P 500, as we see here. Unlike GPIX and SPYI, JEPY places caps on its exposures. Specifically, there is a 17.5 limit on single sector exposure and 1.5% cap on single stock exposure. These measures are there to promote diversification and reduce risk for JEPY. As far as call strategy, JEPY sells out-of-the-money calls on the S&P 500. The fund ladders them weekly with 1-month expiration dates. Most of the time, sold call options have a strike price about 2% above the current S&P 500 index price. Unlike the other two funds, JEPY packages its covered call strategy into equity-linked notes. And ELN income is classified as interest income, and this greatly simplifies the classification of distribution for tax purposes. But ELN income comes at the expense of higher taxes for investors. Most JEPY distributions are taxed as a regular income. I will talk about taxation shortly for these three funds. Before proceeding to SPYI and GPIX, I want to talk about net asset value erosion or NAV erosion. It's a big problem for many cover call funds. It basically says that the net asset value per share of a given fund starts to decline, and because NAV per share is approximately equal to a stock price of a fund, NAV erosion is just saying that the stock price is declining for a fund. Why does NAV erosion happen? It happens because, by law, cover call funds must regularly distribute their realized income. And in down markets, that distribution to you can become a return of capital. NAV erosion is a big deal because it reduces the amount of capital that a given fund has to deploy. And if NAV erosion takes hold, distributions of a fund can start declining, and that's not particularly attractive outcome in retirement. With NAV erosion, an investor may not keep all his distributions, and in that case, at least partial reinvestment becomes a must. If we look at JEPY, its stock price has been roughly up since inception, and that's good. Its portfolio of stocks grew well and was able to counter NAV erosion. However, it is still down since the April drop. It may recover though. But as we will see shortly, SPYI and GPIX are doing better when it comes to managing their NAV erosion risk. The next monthly dividend ETF is SPYI by NEOS. SPYI targets a yield of 10 to 12% and holds all S&P 500 stocks. The fund also sells call options on the index, typically the out-of-the-money ones. This leaves it some room for capturing price appreciation. As we see, SPYI targets a much higher yield compared to the other two funds. And to generate that high yield, the fund must sell more cover calls on its portfolio. In other words, by going heavy on cover calls, SPYI caps upside on a bigger portion of its portfolio. To counter this negative, the fund takes a very active approach when it comes to call options. It even buys call options, and that allows SPYI to participate more in upside from S&P 500, as well as mitigate its NAV erosion risk. And as we see, the fund is roughly up since that April plunge episode, which is good to see. Finally, we have another monthly dividend ETF by Goldman Sachs, GPIX. GPIX also replicates the entire S&P 500 with a cover call strategy for income. Its current yield stands at 8%. To generate this yield, GPIX goes heavy on selling call options on its benchmark. In fact, its sold call options may cover up to 75% of its portfolio. Unlike the other two funds, GPIX sells at-the-money call options. And at-the-money call options provide more premium income, but they cap more upside for future rallies. But here's the thing about GPIX. It doesn't have to sell call options on its entire portfolio. Instead, it does so on a variable basis. Depending on market conditions, GPIX may write call options on as little as 25% of its portfolio. This percentage number largely depends on volatility. As volatility goes up, option premium increase. In that case, GPIX doesn't have to sell a lot of call options to generate a given level of income. There's a huge benefit from this dynamic approach. It allows GPIX to capture a lot of upside when S&P 500 rallies, and that mitigates NAV erosion risk big time. The S&P 500 usually trends up, so this is a sensible approach. And as we see, GPIX actually recovered from that April plunge much faster compared to the other two funds. Next, let's compare total returns. As expected, all three funds lag behind the S&P 500 by their design. But since 2022, JEPY did worse than SPYI. The gap is material at over 20% and growing. And here I want to point out one very crucial feature about JEPY. JEPY holds a different portfolio of stocks compared to the S&P 500. It is more defensive in its nature. It doesn't fall as much, but it also doesn't go up by as much as the S&P 500. At the same time, JEPY sells call options on the S&P 500, not its underlying portfolio. And here we have a mismatch. JEPY does relatively well when the S&P 500 falls. JEPY portfolio falls by less due to its defensive nature, and at the same time the fund gets to keep its premium income. But when the S&P 500 goes up, it goes up more than the JEPY portfolio. So in that case, those cover call positions on S&P 500 create even more cap on JEPY compared to the other two funds. If we come back to upside-downside capture ratios, JEPY showed the worst upside capture. It stood at 47% compared to as much as 80% for GPIX. Since its inception in 2020, JEPY upside capture is better at 58%, but still it's very low. Holding JEPY may be better in declining markets, but it is much worse in upswings. That's pretty much the main reason why JEPY is lagging behind GPIX and SPYI so much. Also, if we look at JEPY yield on cost and distribution growth, there is some growth, but arguably it is worse than for the other two funds. If we take GPIX, it has a lower yield compared to SPYI by almost 4%, but GPIX does not go heavy on cover calls. For this reason, it captured more price appreciation from the S&P 500 than SPYI. Conversely, JEPY is struggling, and this will be generally true after each down and up cycle. JEPY's total returns will lag behind GPIX and SPYI even more. GPIX and SPYI are a new generation of funds that address the NAV erosion heads-on. Because they capture more upside compared to JEPY, their NAV erosion risk is mitigated way more. Why is this important? It is important because a growing NAV per share will ensure that your distributions will grow too. In that case, GPIX and SPYI will show a better yield on cost, distributions growth, as well as overall return profile, much superior to JEPY. If we compare volatility-adjusted returns for three funds, SPYI and GPIX are comparable, but JEPY is doing much worse. Its Sharpe ratio is over 2 times lower. The most important thing to remember with these funds is that in prolonged bear markets, their distributions and overall total returns will go down. Even with lower capture of the downside, this is bound to happen. That's my main concern with these funds. We haven't seen how they behave in prolonged bear markets, and that COVID episode was too short. In bear markets, the stock price tanks, and so the NAV per share of these funds will decline, and so will distributions. Also, the consistency of distributions is far from assured. It depends on the stock price, so if the stock price is down, the distributions will be also down. But also volatility matters. If volatility goes down, the distributions will suffer too. On a final note, I want to address taxation for these funds. If you hold all three in a tax-deferred account like 401k, it doesn't really matter, because anything you withdraw is taxed as a regular income. But holding these funds in a taxable account is a different matter. JEPY is the less tax-efficient of the three. Its ELN's distributions are taxed as a regular income. Conversely, GPIX and SPYI trade so-called 1256 derivative contracts on the S&P 500, and those contracts have preferential tax treatment. 60% of those gains are taxed as a long-term gain, and the other 40% remaining is taxed as a regular income. So in that case, the GPIX and SPYI are more tax efficient in taxable accounts. But there is one more thing about SPYI and GPIX. Most often they distribute so-called return of capital distributions. And return of capital is not taxed. At first, it reduces your cost basis to 0. After that, all future distributions will be taxed as a regular income, regardless of whether they are return of capital or not. There are bad and good return of capital. If NAV per share of a fund grows, return of capital is actually a good thing. This has been the case with GPIX and SPYI. Otherwise, the bad return of capital is just like giving you your money back. Because JEPY classifies its distributions as interest income, it kind of obscures this problem. But either way, if NAV erosion is happening, then you may not keep all your distributions if growth of distributions is your goal. Reinvestment becomes a necessity. So let's summarize and see how these three funds compare. When it comes to yield, SPYI has the highest one. But when it comes to NAV erosion risk, JEPY lags behind the other two ETFs. This is largely due to how both GPIX and SPYI capture more of the S&P 500 upside by their design. Over time, both GPIX and SPYI will show superior returns. But not only that, their distributions will likely grow too. Of the three, JEPY and SPYI show better downside protection, relatively speaking. But when it comes to capturing upside from the S&P 500, GPIX shines. SPYI is second, while JEPY is a distant third. If the S&P 500 continues trending up, GPIX is probably the best choice of the three. But if we enter a prolonged bear market, SPYI can do better than GPIX, and maybe as good as JEPY. Finally, JEPY is the least tax efficient if held in a taxable account. In conclusion, covered call funds cap the upside. As the S&P 500 goes up, they will lag behind it. But in return, covered call funds allow investors to withdraw income on a regular monthly basis. I can see why these funds look attractive, especially in retirement. The yield alone is quite high. But it's important to remember that the S&P 500 is an equity index and it can fall, and our three funds inherit that riskiness, regardless of that covered call overlay. Since 2020, the S&P 500 has been in an almost non-interrupted uptrend, but prolonged corrections can happen. In bear markets, our ETFs' stock prices will drop and their distributions will go down. Dividend consistency may degrade too. This is probably the worst case scenario, but it's important to factor it in, especially if you are planning to rely on covered call funds income in your retirement. Very few asset classes are immune to bear markets. Even dividend funds, the traditional ones, saw their distributions cut in prolonged bear markets. And I don't think that covered call funds are immune to that, and they will see their distributions cut, perhaps even more. As long as you're aware of these risks, covered call ETFs like these three can be a very valuable tool in retirement planning. And that's all for this video. If you enjoyed this analysis, like and subscribe for more content on investing in the future. I will see you next time. All the best!